So let's continue with income from house property. Last class, we discussed some fundamentals as to how to classify a transaction under the head income from house property. So we have gone through all those fundamental concepts, and we were discussing about the procedure for computing income from house property, taxable income from house property. In order to calculate taxable income from house property, two things are important. First is that in order to determine taxable income, you should compute NAV, net annual value, on which we apply deductions, and the result of NAV minus deductions is called taxable income from house property. Now, in order to calculate taxable income from house property, now you're aware that you should calculate NAV, and the calculation of NAV slightly varies depending on whether the house property is a let out property or whether it is a self-occupied property. And the third category is called deemed to be let out property. So let's now go through the format of computing NAV, which is more or less the same for all the three categories with minor differences. This is the format, what you see on your screen, for computing income from house property, which involves a total of 5 steps. And the end result of these 5 steps will give you taxable income from house property. So these 5 steps primarily comprises of two things: a series of comparison between different types of rents, and then you have deductions from gross annual value and also deductions from net annual value. So the first step here is to compare two different types of rents. The first one, if you see the first step, it says municipal rental value or fair rental value. Compare these two and take whichever is higher. And the outcome of the first step is being termed as notional rent. Now, this terminology is purely for the sake of remembering. So if you don't want to use the word notional rent, you can just use the word outcome of first step. So the choice is yours. But for the sake of remembering the format, we have named it as notional rent. So compare municipal rental value with fair rental value and take whichever is higher, and the higher of these two will become the outcome of the first step. But you also need to understand what do you mean by municipal rental value and what is this fair rental value. So municipal rental value, as the name suggests, is determined by the municipal corporation of the city. Now, municipal corporation of a particular city or a town does annual survey, and in this survey they fix the rent of a particular property based on its dimension, based on its locality. So municipal authorities, they fix municipal rental value depending on where the property is situated and what is the dimension of the house. And this is done with the help of a survey. And next comes your fair rental value. Fair rental value, in simple words, is the market price prevalent in the neighborhood. So how much does it cost to rent a house in a particular locality depending on the dimensions of the property. So if you're saying, okay, St. Joseph's College is in Langford town. So Langford town, 1200 square foot, 30 by 40, the dimension, with 2 or 3 bedroom house kitchen. So a house with these specification, what is the rent in Langford town? So when you inquire, you visit 2-3 vacant plots, they tell you the prices. Okay, this is the rental value I'm charging. So that rental value in the neighborhood, which is the average and the most common rental value, is called the fair rental value. So fair rental value is the value which is based on the market sentiments. So this is a value which is determined by the market forces, demand and supply. So it is the rent normally charged for a similar house in the same locality. All two properties can not like in every aspect, but the evidence provided by transaction other parties in the matter of other more comparable to the property in question, and it is relevant in arriving at the reasonable. What does the fair rental value or the market price which the owners are charging, and you can conclusion that okay, for a house this big, this is the average market price, which we generally say fair rental value. So in the first step, we compare these two, find out whichever is higher and take that as the outcome of the first step, termed as notional rent. In second step, we compare the outcome of the first step. Here it is, notional rent, and compare this with the standard rent. Now, standard rent is the rent determined by the government under the law. So each state is empowered to pass a law that regulates the rentals or the rental values of the property, which is popularly known as Rent Control Act. So Rent Control Act is a law that empowers the government to decide and to fix the standard rent. And if this law is effectively implemented in the city or town, nobody can charge a rent which is more than this, So that's the reason in this step, what we do is we write here notional rent or standard rent, whichever is less. And the outcome of the second step after comparing these two, notional rent and the standard rent, the outcome of this step is called expected rent. And in the third step, we compare the expected rent with the annual rental value. Now, annual rental value is a very familiar term for all of you, because when we say annual rental value, that's the actual rent collected by the owner of the house or the landlord of the house from the tenant. And that's the reason this is also known as de facto rent, the actual rent, or known as de facto rent, or you can also term this as actual rent. This is the rent which the tenant pays to the landlord. So we record this and do a comparison between the outcome of the step 2 and annual rental value and take whichever is higher. And after taking that value, from that value, we deduct vacancy period. Now, what is this vacancy period? Vacancy period is the duration for which the house remains unoccupied, even though the owner wants to give the house on rent. But unfortunately, what has happened is he's not finding out a tenant. So therefore, that is a loss to the owner, and that loss can be deducted from this step. Now, in fact, this pandemic has, in fact, as you're aware, has made people to migrate to their hometowns. And when you look at Bangalore city or any other metropolitan cities, most of the houses are vacant at the moment. So maybe after the pandemic gets over, people will return to the cities for the sake of work, and again all these houses will get occupied again. But what about all these months in which the property remains vacant? So that will be considered as a vacancy period. So that will be considered as a vacancy period, and this vacancy period is a loss to the owner of the house, which he can deduct from the outcome of the third step. So vacancy period can be deducted. Now in this, one more point which you have to remember is, which is not mentioned here, when we calculate the actual rent, or let's say it is annual rental value, what we are talking about. So annual rental value is equal to rent, or we can say actual rent collected from tenant monthly months minus unrealized rent. You need to learn or understand what exactly you mean by this unrealized rent, because up to here it makes sense. Annual rental value is nothing but the rent which you will collect from the tenant. And when we say annual, it is for 12 months. But what is this unrealized rent? So this unrealized rent has to be deducted from the annual rental value. So you also need to understand what is this unrealized rent, why it is deducted from the annual rental value. So when we say unrealized rent, it means rent that owner of the house property is unable to collect from tenant. Rent from the house, rent of the house property, which the owner is unable to collect from tenant. Now that sounds quite strange, because obviously when you are giving the house property on rent, the tenant will agree to pay tenant the rent on a monthly basis as per the agreement. You have made an agreement of rent also. Then why would owner is unable to collect from the tenant? So there are various reasons. Sometimes, right, these tenants for various reasons they don't end up paying rent. Right, so they might give you hundreds of excuses. They don't have money, they don't have a job, various excuses, various genuine reasons might also be there. On account of all this or any reason, in case if the tenant is not paying rent to the landlord, it's a loss for him. And this loss is termed as unrealized rent, even though the tenant is staying in the house but is not paying rent. So don't get confused between vacancy period and unrealized rent. Both are totally different. Vacancy period, house is vacant and the owner is unable to find the tenant. Whereas unrealized rent, house is occupied, but the tenant is not paying him for various reasons. So it is a loss. If a tenant is not paying landlord of the house rent, it's a loss. So you might say most of the landlords do collect security deposit. So in case if anything goes wrong, that can be deducted. So that is something which most of the tenants do for a safety purpose. But let's say I am one of the tenants. I'm paying a monthly rent of 10,000 and I've given a security deposit of 1 lakh. So what has happened is for the last 10 months, I have not paid rent. And owner has continuously followed up with me, asked me the reasons. I am saying that I don't have a job. Once I get a job, I'll pay you rent. And unfortunately, last 10 months, I have not paid it all. But the owner is okay because he has my 1 lakh rupees deposit, but that 1 lakh is exhausted now. And another 6 months over, still I have not paid rent. Now the owner can't keep quiet. And the income tax department also has put it very straightforward that if you want to claim unrealized rent, right, just you can't do it just like that. You have to prove that you have taken all these serious steps to collect rent from the tenant. First, you have to prove that. So your claim has to be genuine. Your claim has to be genuine. So what income tax department says is that if you want to claim unrealized rent, it is very important that you satisfy the conditions of rule number 4. Only if you satisfy the conditions of rule number 4, you can claim unrealized rent. In case if you do not satisfy the conditions of rule number 4, you cannot claim unrealized rents. So what are these conditions which are mentioned in 4? So the first condition is that the claim has to be genuine. It can't be a fake claim. At times it may also happen. People might do a fake claim for a simple reason that they don't want to pay tax. So imagine I'm saying that I have not collected rent at all. For the last 12 months, my tenant has not paid me rent. So in that case, what will happen? What is the monthly? In my example, I gave you that I'm paying a rent of 10,000, right? So please 10,000 into 12. This comes to 1 lakh 20,000, right? And now the owner of the house says, no, tenant has not paid me at all for the last 1 year. So unrealized rent will also be 1 lakh 20,000. So now what will happen? Annual rent value will be 0. It will be 0, right? So technically owner is trying to, so there are possibilities that owner might do bungling like this. He might say, okay, tenant is not paying. So income tax department will not listen to the excuses given by the owner. Income tax department will first genuinely ask, fine, if the tenant has not paid you rent for the last 12 months, what have you done to collect the rent from the tenant? What are the efforts which you have put in? So please show us, please prove that you have made all the efforts to collect the rent. Then we will approve unrealized rent. So that is where conditions of rule number 4 comes into picture. So first condition says that tenancy has to be bona fide. What it means is that the claim has to be genuine. It can't be a fake claim. So the tenant is not paying rent. Have you registered an FIR against him in the police station? Have you lodged a complaint against him in the police station? Have you sent notices to him? Where is the proof? So that's important. It has to be a genuine claim. And owner should have taken all legal steps to vacate the tenant, not illegal steps by calling some rowdies and goons and making the tenant beat and threatening him and making him to vacate. So such the illegal steps are not permitted. So you have to take legal steps to ensure that the tenant vacates. So legal steps includes registering a complaint, registering an FIR, sending legal notice to the tenant. So all this has to be done. And third condition is quite interesting. The third condition under rule number 4 says that tenant should not be in the occupation of any other property of the assessee. Now this is quite interesting. And what does it mean? It means, let us say you are the owner of the house. I'm your tenant. You have 3 houses, or let's say you have 2 houses. One in Langford town and the other one is in Shantinagar. I am staying in both the houses. So technically the agreement is between me and you. In Langford town house, I'm staying, and in Shantinagar house, my son is staying. But the agreement is between me and you. So I'm not paying you the rent for Langford townhouse, but for Shantinagar house, I'm paying you rent. If this is the case, then the income tax department will not allow, because the rules number 4 says the defaulting tenant is not in the occupation of any other property of the assessee. That's an important rule. So this rule also needs to be satisfied. And by all means, you have to convince the income tax assessing officer that you have done everything possible to vacate the tenant. You have done all what is necessary, taking all the legal steps. But despite of this, tenant is not paying the rent. So if all these 4 conditions of rule number 4 is satisfied, the assessing officer from the income tax department will consider your request and he will permit unrealized rent. He will approve it. Okay, so this is how you can claim unrealized rent. So you just can't fake it saying that my tenant is not paying. You have to prove it, right? That's important. Now, here another interesting thing you have to note down is this is quite interesting. Why income tax department is doing all this circus, comparing step 1, step 2, step 3. Make it simple, no? Just rent collected. Why don't they ask the SSC to pay tax on actual rent collected? Simple. If it is actual, the taxes on rent collected, things will become more simpler. All the steps is not required. Step number 1, step number 2, step number 3, all this is not required. Make it simple and say that, okay, you have to pay tax on the annual rental value. If income tax department does this, then income tax department will end up in a huge loss for a simple reason that what will happen if this is the case? In this case, the SSC has claimed unrealized rent for 12 months. That means he's not received any rent at all, zero. So that means if income tax department says that the tax is payable on annual rental value, this SSC will never end up paying any tax because the case is in the court. He has filed a case against the tenant and you know how Indian judiciary system works, right? If you want to win a battle in the court of law in India, first thing you have to do is you have to buy a Paragon Hawaii chappal. By the time your Hawaii chappal gets worn out, probably you'll get a call from the court to appear for a date. I mean, the court will give you a date to appear. And by the time this gets over, probably your Paragon will also get vanished. It will get totally worn out. So that's the kind of a system we have in India, wherein you have to wait months, weeks, and years together. The case will go on. So income tax department will remain without tax because this property is disputed. The tenant is not paying rent. The SSC is not getting rental income. The income tax department is very smart. Now what will happen here is, let me just give you an example. Let's say the annual rental value is 2 lakhs. Okay. And fair rental value is 3 lakhs. Done. So this data we have collected from the municipal corporation, the BBMP office. So this data is collected 3 lakhs. And as per the rule, what should we do? We should take whichever is higher. So which is higher? 3 lakhs is higher. So I take this 3 lakhs here. Done. Next comes the outcome of the first step. Record the outcome of the first step, which is whichever is higher. So 3 lakhs. And then collect the data from the BBMP office as to what is the standard rent for your locality. So let's say standard rent is 2 lakhs. And now the outcome of this step has to be whichever is less. And whichever is less will be 2 lakhs. 2 lakhs will be your expected rent. Now what happens is you're saying tenant has not given you rent at all. So here you will say 0. I didn't receive rent for the last 1 year. 0 income. But what does it? This step says take whichever is higher. So what is the higher value? 2 lakhs. Right now, look at the smartness of income tax department. 2 lakhs. So let's skip all the steps and let's finally say that still you have to end up. Still you have taxable income of 2 lakhs. Technically, you have not earned even a single pie from your house property because the tenant is not paying any rent. But the format is designed in such a way that even if the tenant is not paying rent, if you still have given the house property on let out, you still end up paying tax on this 2 lakh rupees. So now do you understand the logic as to why income tax department is saying that the taxable income from house property is obtained by calculating NAV, and from NAV you have to deduct these two deductions. So income tax department does not say tax is on annual rental value, but it rather says tax is on NAV after deductions. So now technically your income is 0, but still you have to pay tax on this 2 lakhs. From where did we get this 2 lakhs? The answer is by comparing all this. So where do we get data of municipal rental value? The answer is BBMP. Where do we get fair rental value data? You can only determine, or you can take the records from BBMP office. Standard rent, fixed by the government. So we can take the data from revenue department, from BBMP, from BDA, right, and calculate NAV and taxable income from house property. So this is how we compute taxable income from house property in case if the property is LOP. LOP is wherein let out property, you have given the property for rent. Now you also have SOP, self-occupied property, in which you're only staying. You're not given it for rent. So for that also you have to pay tax. The answer is no. If you're staying in your own house, you have only occupied the house, and why would you pay tax? Technically, this house is not generating any income. It's being used by you. So you need not pay any tax, but you should still calculate the value based on this format, which is much easier to remember. So here, the first step itself, direct NAV, which is 0, nil. So point to be noted here is the NAV of a self-occupied property will always be 0. Okay. From this, you can claim deduction. What is this deduction? Interest on loan taken. So in case if you have taken house on loan, home loan, construction loan, renovation loan, that interest can be deducted. Now you might ask me, sir, where is the income to deduct interest? So there is no income at all. So whatever interest you're paying, that becomes loss from house property. So this loss from self-occupied house property can be adjusted with the income of let out property, which is very good. It is actually helping a lot. Right now, you might say, sir, I don't have any other property. The only house I have, I am staying in that. So how can I adjust the loss of my self-occupied property with another property I don't have? Still, if you don't have, this loss from self-occupied property can be adjusted with other heads of incomes, like salary. You can adjust this with other heads of incomes. Now we will not discuss that because in the next semester you have a detailed chapter called set off and carry forward of losses, in which we will discuss which loss can be adjusted against which head of income. But the point which you need to understand here is that self-occupied property will not have any income. So therefore NAV will be 0. But you can claim deduction for interest paid on home loan. The house in which you are staying, if you have taken that house on a home loan, right? Or you have taken any loan for construction of the house or repair, renewal, any loan towards the house, interest you have paid, that will become the loss from self-occupied property, which can be adjusted against the income of other sources. Now, what are the deductions allowed for a let out property? So there are 2 deductions. One is from GAV and one set of deductions are from NAV. So from GAV, what you can deduct is municipal taxes. So I'll just write here deductions from gross annual value. So there's only one deduction here, which is municipal taxes. Now, in order to claim this deduction, municipal taxes, again, there are certain conditions which are very important. So what are the conditions under which municipal taxes will be allowed as deduction? In certain cases, municipal taxes will not be allowed as deduction. So you should know, in order to claim municipal tax as a deduction, what are the conditions that needs to be satisfied? So there are 3 conditions that needs to be satisfied. Condition number 1, the property is let out during the whole. The property can be let out during the whole or any part of the previous year, does not matter. The municipal taxes must be paid by the landlord. So this is an important provision which you have to remember, that the municipal tax must be on by the landlord. If the tenant is paying municipal tax, it is not allowed as deduction. It has to be paid by the landlord. And the municipal tax must be paid during the year. Right. What it means is 2 things. One, outstanding is not allowed. So you cannot claim municipal tax payable as deduction. It should be paid. Second thing, you can claim municipal tax paid for any year. What this means is during the previous year 1920, I have paid two municipal taxes. One, let's say I paid 10,000, and this 10,000 is pertaining to 5 years back. This is pertaining to 2014-15, and there is second one which I have paid, which is pertaining to the current previous year, which is 2019-20. Also, I have paid 10,000. This is pertaining to 2019-20. So, do you think is this allowed? The rule says yes. You can not just pay municipal tax, but you can claim as reduction for municipal tax paid pertaining to any year. Need not necessarily has to be the previous year. But what is important here is outstanding cannot be claimed as reduction, and it has to be paid by the landlord. Tenant or any other person cannot pay for it. So if these two conditions are met, you can claim municipal tax. Now, apart from this is one deduction which is from GAV. You can claim municipal tax, but there's one more deduction which is from NAV, and this is deduction under section 24. Just the way you have deductions for salary income under section 16, there are three. Similarly, for house property, the deductions are under section 24. So first one is standard deduction of 30%. Right now, once a tenant leaves a house, one more new tenant will come, and owner has to do repairs, painting, cleaning, all that maintenance expenses will be there. So owner cannot say, okay, can I deduct maintenance expenses from NAV? Can I deduct insurance expenses from NAV? I have a property insurance of the house. Can I deduct all this? So income tax department says owner cannot claim any deductions. He cannot claim repair, painting, renewal, all this he cannot claim because we are giving him flat 30% deduction. Whether he incurred any expense or not, irrespective of this, he is entitled to claim a flat deduction of 30% on the NAV. The second deduction is interest on loan. So these are the two deductions under section 24. So this is how we calculate NAV of a house property which is let out. So three categories as I mentioned. LOP means let out property, SOP means self-occupied property. Now what is deemed to be let out property is what we will understand, and then we will go for Q&A session. Okay, so what is deemed to be let out property? Now as per the rules, income tax department says you can have multiple properties. Let's say I have 5 houses and all the 5 houses I've given it on rent, or let's say I've given 4 on rent, okay, and 1 I stay myself. So 4 let out properties and 1 self-occupied property. But what happens in the year 2019-20 is that 3 properties I have given it on rent. 4th property I have not given it on rent. I am planning in that house let my children stay, and anyways I have my own house, so I'm planning property number 4 to be given it to my children, but I've not yet given to them. It has remained vacant. In the 5th property I am staying. So income tax department says you can't have more than 1 self-occupied property. Now in case if I give that property to my children also, that is also my house only, because the house is registered in my name. So income tax department says you can't have more than 1 self-occupied property. In case for tax purpose, I am saying you can have as many as self-occupied properties technically, but for tax purpose, you can have only 1 self-occupied property, and you can claim deduction only for 1 self-occupied property. In case if you're using more than one, the other property which you are using it for self-occupied will be considered as deemed to be let out property. In case if you have more than 1 self-occupied property, the other property which is also self-occupied will be considered as deemed to be self-occupied property, and on this also you have to pay tax. Now you might wonder, sir, how will we pay tax when you are not receiving rent itself? The answer is rent is immaterial, because income tax department has designed the format in such a way Even if the rent is zero also, you still end up paying tax. So deemed to be let out property, we will follow the same procedure as self-occupied property. Only difference here is that deemed to be let out property, annual rental value will always be zero. That's it. Otherwise, the format is same. So deemed to be let out property will follow the same format as let out property. Only difference is that annual rental value will not be there. That's it. The other things will remain as it is. So this is how we compute NAV, net annual value.
Now can you explain the DLOP?
DLOP, the rule says in case if the owner of a house has more than one self-occupied property, anything more than one will be considered as deemed to be let out property. So when we say deemed to be let out, the procedure of calculation will be same as let out property. Only difference is that in deemed to be let out property, annual rental value will always be zero because you're not getting any rent from this property. You're only staying this. I mean, you have only occupied this property. So ARV will always be zero, but it is still taxable. So we'll follow the same steps what we do for LOP and compute the taxable value. So as per the rules, if you have occupied more than one house, then the other house except one will be considered as deemed to be let out. And you have to pay tax on that. Do we pay tax on self-occupied property? The answer is no tax, not taxable. But advantages, you can loss. What is loss here? Interest on home loan. So once we do more numerical questions, you will get more clarity. Once we apply all this theory, what you have studied in the last two classes, when we apply this in the form of numerical illustrations, then you will be in a better position to relate what we discussed with the actual questions. So that's the best way to understand theory concepts by working out numerical illustrations.